Ever pulled out a sleek credit card, maybe one of those distinctive Amex ones,
Yeah.
and wondered what's really going on behind it? How does that company actually make its money? And, is it built to last in today's crazy financial world?
Yeah, it's so easy to just see the card or like the tap to pay on your phone, but really understanding the engine underneath the whole system, that's key if you want to figure out its long-term strength.
Exactly. And that's really our mission for this deep dive. We got a whole bunch of source material from a listener, stuff like business quality analysis report, Amex's own annual reports, financial data sites, news articles, all focused on digging into one specific company, American Express, ticker AXP.
Right. So we're using this framework kind of inspired by investors like Buffett and Munger, and our goal is to go through only what these sources tell us. We want to pull out the really important bits and figure out if Amex, based just on this info, looks like, a wonderful company, something you might consider for the long haul.
We're going to unpack the business itself, the management, how healthy the finances look, and tackle those big questions about the future, all to give you a kind of shortcut to getting up to speed. We're hunting for those aha moments together.
Okay, let's jump right in.
All right, let's unpack this. Priority one, the absolute core. What is this business? How does American Express actually make money based on what these sources said?
Well, the sources don't just call it a card company. They describe Amex as, a globally integrated payments company. It's got this multifaceted model. They're involved in issuing the cards and signing up the merchants who take them. Basically, they make money in three main ways.
Three main streams. Okay, let's break those down.
First, and the sources say it's the biggest piece, is discount revenue. That's the fee the merchant pays Amex every single time you use your card. You tap, you swipe, Amex gets a percentage.
Man, the sources mentioned they charge merchants more than Visa or MasterCard.
Yeah, historically that's been the case. The sources point to the Amex cardholder base.
The customers themselves.
Right. They tend to be more affluent, and this is key. They spend more per purchase on average than folks using other networks. So merchants are often willing to pay that higher fee to get access to those bigger spenders.
Interesting. So Amex gets a bigger slice because its customers bring more valuable business.
Okay.
What's the second revenue stream?
Second one is net card fees. Pretty straightforward. It's the annual fees you pay to hold many of their cards, especially the premium ones, the co-branded ones. The sources really emphasize this is a significant and actually a growing part of their revenue.
So that $700 fee on a platinum card isn't just pocket change for them. It's a real pillar of the business.
Definitely. And the third stream is net interest income and other. This is interest they charge when cardholders carry a balance, particularly through features the sources mentioned called pay over time, apparently increasingly important. Plus, fees for using the card overseas, late fees, that sort of thing.
Got it. So basically, profit from spending volume and value, profit from the membership fees, and profit from lending. Spend, membership, credit.
You got it. Now, building on that, the next big question the analysis digs into is, okay, is this whole model easy to wrap your head around? And more importantly, does it look like it will still be relevant in, say, 10 or 20 years?
Well, based on the sources, the idea of facilitating payments and providing credit.
Yeah,
that seems pretty fundamental. Hard to imagine commerce without it. So yes, seems understandable and deeply embedded.
And its long-term relevance. The sources argue, yeah, it's relevant, because the basic need for payments isn't going anywhere, right? Even if how we pay changes. They point out Amex is putting a lot of money into digital transformation, mobile apps, online stuff, contactless payments.
So they're not just banking on plastic, they're trying to keep up with digital wallets and everything else.
Exactly, and credit's still a vital tool for lots of people and businesses, so their role as a lender stays relevant if they manage the risk well. And then there's that brand, that value proposition. Membership has its privileges. The sources really go into the focus on the premium customer, offering better service, rewards, travel perks.
That aspirational side. It must appeal to a group that's likely to stick around, maybe even grow as global wealth increases.
Precisely. And the sources bring up their history, how they've adapted before, from basically a delivery service way back when to this financial powerhouse. Now they're investing in tech, AI, partnerships, and critically trying to attract younger folks, millennials and Gen Z. It suggests they're actively working to stay in the game.
Okay, so even with all the competition and tech disruption flying around, the core need seems durable, and Amex looks focused on evolving. That leads us right into their defenses, the economic moat. What's the main competitive advantage here, according to the sources?
The sources really highlight a combination. It's intangible assets, mainly that super strong brand and network effects, which come from their unique closed-loop system and that premium customer base. Then you've got things like switching costs and maybe some cost advantages supporting those.
Let's talk about the brand first. That seems huge.
Oh, it is. The Amex brand is described as, globally recognized. It signals prestige, trust, security, top-notch service, built up over 175 plus years. The sources even put a number on it. Forbes called it one of the world's most valuable brands. Brand Finance valued it at $36.5 billion in 2025.
Wow.
Yeah, and this brand equity isn't just fuzzy feelings. The sources say it lets them charge those higher merchant fees and creates kind of psychological edge. Choosing Amex says something.
It's more than just a payment method for some. It's a bit of a status symbol. Okay, now the network effects, especially that closed loop system, this is where it gets interesting, technically.
It really is. See, the sources explain that with networks like Visa or MasterCard, you usually have a bank issuing the card and another bank handling the merchant's side, the acquirer. Amex often does both. They issue your card and they work directly with the merchant.
Right, so they control the whole transaction end to end. How does that create a network effect?
Well, because they're on both sides, it creates this two-sided network. More cardholders spending money makes merchants want to accept Amex, right, to get that spending.
Makes sense.
And the more merchants accept Amex, the more useful the card becomes for you, the cardholder. Now, historically, maybe they weren't accepted everywhere, but the sources say they've massively boosted acceptance. They cite something like 99% of places in the U.S. that take credit cards now also take Amex.
99%. Wow, okay, that's way higher than the old perception. That definitely strengthens the cardholder side of the equation.
Big time. But the real kicker from this closed-loop system, according to the sources, is the data.
Because they see the whole picture.
Exactly. They see who's buying what, where, when. The sources state this gives them way better insights into spending patterns, credit risk, fraud, compared to the open-loop guys who only see their piece of it. This translates into better risk management. The sources mention lower credit losses for Amex and lets them do really targeted marketing and personalized rewards.
And you have to assume that data advantage just gets more powerful as they get more transactions and better AI to analyze it all.
Precisely. That deep data intelligence is called out as a major competitive barrier, hard for others to copy without seeing the whole flow.
What about switching costs? Do the sources see people getting locked in?
Yeah, they do, especially for the big spenders and businesses. If you've got tons of membership rewards points saved up, or your company's whole expense system runs on Amex cards, or you have established credit lines, the sources say switching becomes a real pain. You lose accumulated value or face operational headaches. That discourages jumping ship.
And any cost advantages from this setup?
The sources suggest, yeah, potentially. Those data insights could lead to savings in fraud prevention, better risk modeling, maybe more efficient marketing spend because it's so targeted. One source, Guru Focus, is mentioned regarding economies of scale and proprietary tech helping on the cost side, too.
Can we see this moat in action? Is there a good example in the sources?
Yeah, think about a frequent traveler, maybe someone with an Amex Platinum card. The sources mention that high annual fee, what is it, $695 now?
Totally like that, yeah.
Right. But the cardholder pays it because they value the whole package. The airport lounge access, the travel credits, hotel status, maybe the concierge service. They feel the value they get outweighs that hefty fee.
Okay, I get that. I know people who love those perks.
Exactly. Now, flip side. Why do merchants, especially, say, high-end restaurants, luxury stores, airlines, accept Amex even if the fee is a bit higher? The sources explain it's because they want that customer, the high-spending Amex traveler.
They want access to that spending power.
Precisely. And then Amex uses its closed-loop data to see what that customer likes and offers them targeted deals Amex offers, often with those same premium merchants. It reinforces the whole loop.
So the customer likes the perks and spends. The merchant accepts to get the spender. Amex uses data to make both happier and more connected, and the customer gets more locked in by the rewards and convenience.
It's a really powerful self-reinforcing cycle. The sources stress the challenge for competitors isn't just matching one perk, like lounge access. It's replicating that entire bundled premium experience. And that's really, really tough.
So how durable is this whole setup? Is the moat getting wider, narrower? What's the assessment?
The sources kind of land on stable overall, but interestingly, they see some parts widening, especially in their core areas. Premium consumers, small and medium businesses, while also facing increasing pressure from elsewhere.
Stable but pressured. Okay, what's keeping it stable or even widening it?
Well, the brand strength is seen as incredibly powerful and lasting. They keep investing in it premium experiences, marketing, partnerships. The sources point to high customer satisfaction scores, like #1 in the US from JD Power. And crucially, they mention Amex is actually succeeding in attracting millennials and Gen Z to these premium cards. That suggests the brand appeal isn't just for older generations.
That's huge for the future, getting those younger, affluent customers.
Absolutely critical. Then the network effects are holding up, especially as they strategically push for acceptance where their target customers actually shop and spend. And that data advantage. With AI and better analytics, it's arguably becoming more valuable for personalization and managing risk, not less.
And their focus on small and medium businesses, SMEs, seems to be building loyalty there too.
Yeah, the sources describe that as a smart move. Tailored product, services beyond just the card transaction. Business relationships tend to be stickier.
Okay, but what about the pressure? Where's that coming from? What could potentially shrink the moat?
The biggest one, hands down, is intense and diverse competition. It's not just Visa and MasterCard nipping at their heels who are also innovating like crazy. It's this whole wave of FinTechs, PayPal, Block, which is Square, Stripe, Apple with its card, and pay by now, pay later guys. They're all chipping away, often with a digital-first approach, maybe lower fees, unbundling services.
Right, trying to grab pieces of the payment chain.
Exactly. And then there's the sheer pace of technological disruption. The sources acknowledge that new stuff, real-time payment systems, maybe blockchain, even potentially government-backed digital currencies down the line, could eventually create ways to bypass the traditional networks altogether. Amex is investing to stay ahead, but things are moving fast.
Regulation often plays a role in finance, too.
It does. The regulatory environment is another pressure point. There's always scrutiny on merchant fees, interest rates, capital levels. Changes there could definitely squeeze their flexibility and profits.
And just maintaining that whole premium package,
Yeah.
that can't be cheap.
No, it's not. The sources explicitly mention the cost of maintaining premium differentiation. Think about all those rewards points, the lounge access, the high level of customer service it costs a lot to deliver. They have to constantly innovate and invest to make people feel that premium fee is justified, especially when cheaper options are popping up everywhere. They mention the CEO, Squeri, has this philosophy of only raising fees when they add real value, which seems vital.
So really, the moat's strength boils down to whether customers keep believing the whole premium bundle, the brand, the service, the rewards, is worth the extra cost, especially as these potentially slicker, cheaper digital alternatives keep coming. If that perceived value drops, well, the switching costs don't matter as much, and the network isn't as powerful.
That's the core tension the sources identify. It demands constant, heavy reinvestment. The risk is that the big, expensive bundle just becomes less appealing or too pricey compared to competitors who offer maybe just one piece of it really well and cheaply.
That paints a really clear picture of the business and its defenses. Let's shift gears now to priority 2, the folks running the show and the company's financial health. Who's in charge in Amex, and what do the sources say about their leadership style?
The top guy is Stephen J. Squeri. He's chairman and CEO, been in that role since early 2018. But the sources really emphasize his history. He joined Amex way back in 1985. So deep institutional knowledge.
Wow, okay. A real long-timer. What's his core philosophy based on the source material?
From what's cited, like shareholder letters, it's very much focused on long-term value creation, not just hitting quarterly numbers. The sources quote his strategy as focusing on investing in our value propositions, coverage, marketing, technology, and talent. The goal: sustained top-line growth, superior earnings, and strong returns.
So willing to invest for the future, even if it means maybe not maximizing profit this very second.
Yeah, the sources definitely suggest that. They even have a quote from him saying something like, "I'm not going to pass up good opportunities to invest for the future just to hit a number." The 2024 annual report apparently credits this long view approach, especially how they managed through the pandemic, for setting them up for the growth they've seen recently.
Okay, so how does that translate into where they put the company's money? Capital allocation. Where does the cash actually go?
Priority number 1, according to the sources, is reinvesting right back into the main business. That means big spending on technology. We're talking digital platforms, mobile apps, improving the online experience, but also sophisticated stuff like AI for detecting fraud, data analytics, and new payment tech like tokenization and open banking things. The 2024 report apparently goes into detail on these large, ongoing tech investments.
Tech is clearly a major spending area. What else?
Marketing and product development, also huge. This is vital for keeping that brand strong, attracting new customers, and making sure the card benefits feel fresh and valuable. The sources mentioned they refreshed over 40 products globally in 2024 alone, including big ones like the U.S. Gold Card. Plus, high-profile stuff like sponsoring Formula One racing to get the brand out there.
Sounds like they're spending heavily to win and keep those premium customers.
Absolutely. The goal is to expand their leadership in premium consumer and business segments. They also invest in coverage, just making sure the card is accepted in more places around the world.
What about buying other companies? M&A activity.
The sources suggest it's more targeted. They call them tuck-in deals, smaller acquisitions, not giant transformative ones. The idea is to add specific capabilities or boost their offerings in key areas.
Got an example from the sources?
Yeah, they mention a couple from 2024, TikTok and Room, which were focused on the dining scene, makes sense, fits with their customer spending. And then more recently, April 2025, they bought a company called Center, which does expense management software for small and medium businesses. That lines up perfectly with their strategy to grow in the SME market.
So, smart, strategic buys that fit the existing plan, not just buying stuff for the sake of it. Okay, and what about returning cash to shareholders? Buybacks, dividends.
Oh yeah, strong history there. The sources detail pretty significant share buybacks lately, like $6 billion in 2024, over $3.6 billion in 2023, $3.5 billion in 2022. They do note this is subject to Fed oversight through the CCR process.
And dividend.
Also a long, consistent track record and a policy of increasing them. The sources mention a recent 17% hike to serve $1.82 a share starting May 2025. Total payouts were also substantial, nearly $2 billion in 2024. And the payout ratio is noted as being pretty conservative, maybe around 20% of earnings.
A 20% payout ratio.
Oh.
That leaves a lot of room for more dividend growth and all that reinvestment.
Exactly. The sources see that low ratio as a sign the dividend is safe, with plenty of capacity for future increases while still funding investments and buybacks.
Okay, putting it all together, does this pattern of capital allocation look rational? Shareholder friendly, based on the sources?
The sources definitely lean towards yes. Putting money back into the core business first makes sense for strengthening it. The M&A looks disciplined and strategic, and consistently returning the excess cash via buybacks and a growing dividend shows a clear focus on shareholder value. It aligns with that long-term CEO perspective.
And crucially, how does all this spending tie back to defending that moat we talked about earlier?
That's a key link the sources make. The tech spending. It improves the customer experience, boosts security that helps the brand, and it leverages the data from the closed loop, strengthening the network effect. Marketing and new product features. They keep the brand feeling premium, justify the fees, maybe increase switching costs. And those acquisitions in dining or SME tools, they deepen engagement in key areas, making the network stickier for those customers. They're actively spending to build and protect their advantages.
So it's not just random spending, it's strategic investment aimed right at their core strengths.
Exactly. Although the sources do add an important caveat. Because Amex is a bank holding company, the Federal Reserve watches them closely, especially through those CCR stress tests. This impacts how much capital they can actually return. So even if they want to do huge buybacks or dividend hikes, they need the Fed's green light. Add some prudence, but maybe limits management's total freedom a bit.
Right, regulatory overlay. Okay, let's get into the numbers. How has the business actually performed? Profitability, consistency. Especially looking over the last 5 years, including that weird 2020.
The sources show a clear picture of generally growth and resilience between 2020 and 2024. But yeah, with that big obvious dip in 2020 because the pandemic just crushed travel and spending for a while.
Let's look at revenue first. We have table 1 from the sources.
Okay, revenue fell pretty hard in 2020, down to about $36.1 billion from nearly $43.6 billion the year before. But the sources show a really strong bounce back starting in 2021, $43.01 Bs, then a big jump in 2022, $52.06 Bs, more growth in 2023, $60.24 Bs, and then a record year in 2024, over $66 billion. The latest trailing number into Q1 2025 is over $67 billion.
Wow, that's a fast recovery and then really strong continued growth after the pandemic hit. How did net income track?
Similar story, also in Table 1. Net income took a big hit in 2020, dropping to just over $3 billion from $6.7 billion in 2019. That was partly lower revenue, but also because they set aside a lot more money for potential loan losses, bracing for impact.
Right, the provisions.
Exactly. But then it snapped back really strongly in 2021 to $7.9 billion, helped a bit by releasing some of those earlier provisions. Then it was $7.4 billion in 2022, grew to $8.3 billion in 2023, and also hit a record in 2024, over $10 billion. The trailing 12 months into Q1 25 is just over $10.1 billion.
So if you kind of mentally bracket out 2020 as an anomaly, the underlying trend has been pretty consistent growth in both revenue and profit.
Yeah, the sources really highlight that. Excluding 2020, the pattern is growth. And the speed of the recovery after the pandemic really points to the strength of the brand, customer loyalty, and, effective management. It shows the business is sensitive to big economic shocks, sure, but the core profit engine seems very robust.
Okay, now let's dig into some of those quality ratios. We've got table 2 from the sources. How does ROIC look? Return on invested capital.
Yeah, and we have to remember these ratios need careful handling for a financial company. Their balance sheets just look different. So ROIC measures how well they use their capital. It dipped low in 2020, like 4.2%, but jumped right back up to 11.6% in 2021. Since then, it's stayed pretty consistently in that 10% to 12% range, right through 2024 and into Q1 2025, which was 11.8%.
And the sources mentioned at WACC, the cost of capital, is estimated somewhere in the 7-10% range.
Right. So if they're consistently earning 10-12% ROIC after the pandemic, that's clearly higher than their cost of capital. That means they're creating value. Now, 10-12% might not sound as high as some tech companies, maybe, but the sources say that's solid for a mature financial firm that has a lot of assets, like their loan book.
And they also mention return on equity, ROE, is maybe more important here.
Often is for financials, yeah. And Amex's ROE is shown as consistently really high, over 30% recently, like 34-point-something% TTM. That's an excellent return on the money shareholders have invested.
Why such a big difference between ROE and ROIC?
The sources explain that's pretty typical for financial institutions. It comes down to how they fund their assets using a mix of debt, deposits, and equity. ROE just looks at the return generated on that equity slice, so leverage can amplify it.
Got it. Okay. How about free cash flow margin? How much cash are they actually generating from sales?
This number is pretty substantial, but as the sources warn, it can jump around a lot for financials. Table 2 again. It was 11.4% in 2020, then spiked way up over 30% for a few years, but came back down to around 18.4% in 2024. That volatility is normal. It gets affected by swings in things like card loan balances growing or falling. But the key thing is the underlying cash flow from operations is consistently strong. Over $14 billion in 2024, $18.5 billion in 2023, driven by that solid net income.
So strong underlying cash generation, even if the FCF number itself is a bit lumpy. What about debt levels?
Yeah.
The sources say debt to EBITDA needs careful interpretation.
Yeah, because for a company like Amex, debt includes customer deposits and the money they borrow to fund card loans. So the sources use a specific measure, looking just at their interest-bearing corporate debt. Using that, the ratio did spike in 2020 when earnings fell up to almost 8x, but it came down fast to 3.3x in 2021 and has been bouncing around a manageable 3.8x to 4.9x range since then.
Manageable given their profitability using that specific debt figure.
Seems so. The sources also mentioned debt to equity, another common metric for financials, was around 1.83x for 2024 using that same interest-bearing debt definition. And they highlight a strong cash position too, over $40 billion in cash at the end of 2024.
So the overall takeaway on the financials seems to be strong performance, impressive recovery, but you really need to look at the right ratios for this kind of business.
Exactly. The sources keep coming back to that. Standard ratios need context. They really emphasize ROE and those regulatory capital measures as key health indicators. And based on those high ROE, strong operating cash flow, meeting strict regulatory rules, the picture is one of a financially sound and resilient company.
Okay, great. Let's move to priority 3 then. Valuation and the look ahead. If we're thinking about that wonderful company at a fair price idea, how does the current valuation look?
All right, so as of early June 2025, the sources peg the stock price around $295 a share.
And the key valuation ratios. We have table 3 from the sources.
Okay, the TTM trailing 12-month price to earnings ratio is running around 20.5x. That's based on TTM earnings per share of about $14.32 to $14.34. The price to free cash flow, TTM, is estimated somewhere between 17.0x and 17.8x, keeping in mind that FCF volatility we mentioned.
How does that stack up against its own history, say the last 5 years or so?
The sources give a 5-year average PE of roughly 19.6x, so the current 20.5x is, a little bit above that recent average. The PFCF average is trickier because of the swings, but estimates put the 5-year average somewhere between, say, 12.5x 18x and 14.6x.
Okay, so that current PFCF around 17x to 18x looks like a pretty noticeable premium compared to its recent history on that metric.
Yeah, based on that number, it does seem like a moderate to maybe even high premium.
So based on everything we've covered from the sources, the business quality, the moat, the management, the financials, does Amex actually qualify as a wonderful company?
Based just on this source material analysis, yes, it really seems to. It checks a lot of the boxes. That powerful, durable brand, the unique closed-loop advantage, the focus on loyal, high-value customers, the proven profitability and high ROE, management that seems capable and long-term focused, rational capital allocation. It fits the description pretty well based on this info.
All right, wonderful company. Check. But is the current price, around $295, fair? Again, based only on what the sources tell us.
The sources are pretty clear. It's not trading at a bargain price. The analysis suggests the current price reflects the market recognizing its quality, its strong recent performance, and the positive growth outlook after the pandemic. So applying that philosophy, better to buy a wonderful company at a fair price than a fair company at a wonderful price. The big question is this price fair?
And what conclusion does the source analysis draw on that specific question?
Given all those strengths we talked about, the brand, the data, the growth, the shareholder returns, the sources suggest that a price that's modestly above its historical averages might be considered fair. But that's if you're a long-term investor, paying up for that demonstrated quality and assuming they keep executing well.
They also mentioned the company gave guidance for 2025 earnings per share, right? $15 to $15.50.
Yeah. And if you use the current $295 price and that guidance range, the forward PE comes out around 19.0x to 19.7x. The sources note that's roughly in line with, or maybe even slightly below, the trailing PE. So the thinking is, if they actually hit that growth target, the valuation multiple looks a bit less stretched looking forward.
Okay, so the summary on valuation is definitely a wonderful company. The price isn't cheap compared to history, but maybe fair for a long-term buyer who really believes in the continued performance and the strength of the moat.
That's the synthesis from the analysis, yeah. It basically says the market is already pricing in a lot of that quality. You're paying a premium for it, not finding a hidden gem price-wise.
What does that mean for the margin of safety then?
Well, the sources point out that because the price already reflects the quality, the margin of safety for someone buying now might be pretty limited. It's not like you're buying it way below what it's probably worth. The price really depends on the company continuing to execute flawlessly and that moat holding up strong. Your safety margin comes more from the business continuing to be excellent rather than from getting a bargain price.
Makes sense. Okay, looking purely ahead now, what do the sources identify as the single most important driver for Amex's future growth?
They really zero in on a dual approach. Continued success in attracting, engaging, and deepening relationships with those premium consumer segments, especially millennials and Gen Z, and at the same time, expanding the value and services they offer to small and medium-sized enterprises, SMEs.
That combo makes sense. Play to their premium strength, but also grab a bigger piece of the business market.
Exactly. Premium consumers are their bread and butter, driving high spending and those valuable fees. The sources emphasize millennials and Gen Z are their fastest growing groups for new accounts and spending. Winning them over is crucial as they enter peak earning years, especially since their spending often aligns with Amex's strengths like travel and dining. For SMEs, it's a huge market, maybe underserved. Amex is pushing tailored products, lending, and more beyond the card stuff like expense management that Center Acquisition fits right in. Business spending is big, and those relationships can be really sticky.
So basically, win the young affluent crowd and become essential for small businesses. That's the growth playbook. Okay, given all that potential, what are the top 2 or 3 really serious long-term risks highlighted in the sources? Things that could genuinely, maybe permanently, damage their earning power.
The number one risk has to be intensifying competition and the pace of disruptive technological innovation. The payments world is just incredibly competitive and changing so fast. You've got the traditional giants, Visa, MasterCard, innovating hard. But then you have all the FinTechs, PayPal, Block, Apple Pay, BNPL coming at it from different angles, often with lower costs, slick digital experiences, unbundling things Amex offers as a package.
Right, the risk of being outflanked or having their core model disrupted by something cheaper or faster, just different.
Exactly. And the sources even mention the long-term potential for things like blockchain or maybe central bank digital currencies to create payment rails that bypass networks like Amex entirely. The risk is they fail to adapt quickly enough, lose market share, face pressure on their rates, and have to spend massively just to keep pace. That could permanently hurt earnings.
Okay, that's a big one. What's the second major long-term risk?
Yeah. A sustained severe economic downturn, or maybe a fundamental negative shift in how premium consumers behave. Amex's model, being so tied to spending, especially discretionary stuff like travel, dining, luxury goods, makes it sensitive to the economy. Yes, their customers are generally more affluent and maybe more resilient, but a really deep, long recession would still hit spending hard and impact loan repayments.
And the more fundamental shift.
That's the deeper worry the sources mention. What if, over time, affluent consumers just start valuing that whole bundled premium package less? If the status, the perks, the service, if the privilege just doesn't seem worth the high fees anymore, especially if slick, cheap, unbundled digital options get really good, that would undermine their whole value proposition, make it hard to charge premium fees, and potentially lose those high spenders. That would be a structural hit to their earning power.
If the membership has its privileges, magic starts to fade.
Yeah.
Yeah, that's a core problem. What's the third big risk area?
Material deterioration in credit quality and maybe ineffective risk management. As Amex leans more into lending with credit cards and those pay over time features, their exposure to credit losses grows. Now, the sources acknowledge they have a great track record here, very sophisticated risk management. But a really nasty, widespread credit downturn could still lead to much higher loan write-offs, especially if expanding into maybe younger demographics or certain SME segments introduces new, less predictable risks.
And higher write-offs hit the bottom line and capital directly.
Absolutely. A big sustained jump in credit losses would hammer net income, eat into capital, and limit their ability to invest or return cash to shareholders. The sources also add a specific note about their closed-loop risk concentration. Remember how that's an advantage for data? Well, the flip side is it concentrates risk. Amex is both the lender and takes the merchant risk. So if they make mistakes in underwriting or have operational screw-ups or face tech issues hitting their integrated system, the impact could be bigger and more direct than for someone in an open-loop system. It just highlights how critical it is for them to be absolutely excellent at managing risk, credit, and operations.
Right. The structure that gives them an edge also concentrates certain risks.
Okay, let's try to pull all these threads together now. Final synthesis from the sources. What's the summarized bull case? Why be optimistic about Amex long-term? Okay, the bull case, based on this analysis, boils down to a powerful, enduring premium brand combined with a differentiated network that gives them that closed-loop data advantage and strong network effects, especially in premium and SME niches. They have proven management with a clear long-term strategy, successfully adapting and investing in growth areas like younger, affluent customers and SMEs. Their financials are robust, strong profits, high ROE, resilience shown post-pandemic, and smart, shareholder-friendly capital allocation. And the underlying spend-centric model, focused on affluent spenders, provides high-margin revenue and seems like a durable growth engine.
Okay, that's the bull case. Now, the bear case.
Yeah?
What are the critical counterarguments, the big risks to keep front and center?
The key bear points are that intense and constantly evolving competition from everyone, traditional players, fintechs, potential new tech disruptions. There's the macroeconomic sensitivity and credit risk inherent in their spend-based model and their direct lending exposure. There's the ongoing challenge of sustaining premium differentiation. It's expensive to maintain those benefits, and they constantly have to prove they're worth the price against cheaper alternatives. And finally, the valuation already reflects quality, meaning it's not cheap, offering potentially limited margin of safety and demanding near flawless execution going forward.
So wrapping it all up, based only on this deep dive into the source material we were given, what's the final take on American Express as a potential wonderful company?
Well, based purely on this analysis, Amex definitely shows many hallmarks of a wonderful company. You know, the brand, the unique network, the customer focus, their adaptability, the management quality, the strong financials, those are clear pluses. But the sources are equally clear about the significant challenges, the fierce competition, the economic sensitivity, the constant need to justify being premium, the credit risk. And the valuation reflects this quality. It's seen as perhaps fair rather than a bargain, according to the sources.
So not a clear slam dunk either way from this material alone.
Right. Ultimately, for a long-term investor focused on quality, the decision based on this analysis seems to hinge on your conviction. How strongly do you believe that Moat will hold up against all those pressures? And how confident are you that management can keep executing almost perfectly?
Exactly. The lack of deep discount means your safety net, if you will, comes from the business continuing to be truly excellent, not from buying it super cheap. Well, that was a really thorough exploration. We pulled out some fascinating details from that source material. The power of that closed-loop data, the specific growth drivers, those financial nuances. Hopefully, this gives you, the listener, a much clearer, more informed perspective on American Express, seen through this particular business quality lens.
Yeah, it definitely lays out the strengths that have made them so successful for so long, but it also puts those future headwinds and risks squarely on the table.
Absolutely. Now, here's something to chew on, building on all this.
Mm-hmm.
In a world that seems to be rushing towards unbundled services, frictionless payments, often lower costs, how much is that premium brand, that whole package of rewards, service exclusivity, how much is that truly worth over the very long term? And maybe more importantly, what could cause that perceived value to really shift for the customers Amex depends on most?
That's a really good question to ponder as this whole industry keeps changing so fast.
Indeed it is. Keep exploring. Keep thinking critically. Thanks for joining us for this deep dive.